Welcome everyone on this real estate investment podcast, and we have some very good topic to discuss. My name is Seewing from the Real Estate Network, and my special guest is Maureen McCann from Spartan Invest, and we're gonna dive very deep into a topic which I find, and I'm sure you'll agree, Maureen, because we work with real estate investors from all over the country to buy turnkey cash flow, high appreciation markets, in that even not only newbies, but even sophisticated investors, based on my experience, I think they still do not know how to analyze a deal. Think about it. I mean, how do you analyze a deal before you pull the trigger? And most people, they just look at one limited financial picture before they will make a judgment. They do not understand the total big real estate financial picture to make an informed decision to buy an investment property. Okay, Maureen, do you understand the frustration that you and I have been experiencing lately? So, okay, without further ado, let's share my screen and dive in. Let me.
Can't wait to see what you got.
Oh yeah. You know it. Here we go again. All right, here we go. All right, we're using this property as an example. Although this is a real property, as a matter of fact, this property is something that Spartan Invest have. But anyway, this is a good example, okay? Now, let's say you are a real estate investor. You are analyzing a property. You have done a lot of research and due diligence. You're ready to pull the trigger. You qualify to get 20 to 25% down payment. Your loan pre-approval. You find a market that you want, cash flow market, good appreciation, good population growth, job growth, the whole 9 yards. All right. Now you're doing the real final due diligence in terms of proforma analysis, in terms of cash flow analysis, or whatever. Right. And let me just, this is such a, I'm sure Maureen, you'll agree, this is so important. I mean, the face value of proforma is not enough for you to make to buy a rental property in whatever market you're trying to target. Because in the past, before the pandemic, right, we're talking like, 7 years ago or 4 years ago, or when we have a lower interest rate, 4%, 4.5%, even though today's interest rate is 5%, mortgage rate should not impact a real estate investor whatsoever. Your cash flow may be a little bit less, but again, let's talk about that. So most people, right, investor, when you buy a property, it's like, oh, we are like new construction, right? I mean, we're not going to go over the detail why real estate investors love new construction, new builds, right? Taking cash flow. So let's use this example, $250,000. Some investors come to me, you likewise in the past 2 years. Maureen, I want to get a new construction, $250,000. I want a cap rate of 7%. Well, my definition of cap rate of 7% is the rent to buy this property, $250,000. In fact, let's say this. Some people, we talk about the 1% rule, right? The 1% rule, the 1% rent to value ratio. When you're analyzing investment property for, in this case, $250,000, 1% multiplied by 250,000 should equal your gross monthly rent. So 1% multiplied by 250,000 is $2,500, right? So when an investor come to me or come to you, right, for initial phone consultation or Zoom, whatever, right? They want, Maureen, I want a property, $250,000, new construction, that rent for $2,500. They have unrealistic expectations given to what's going on in today's real estate environment, right?
Yes, agreed.
Because in the past 2 years, we're seeing skyrocketing appreciation for, for the reasons that you already know about, and even though skyrocketing rents are trying to catch up, and it can't, we're seeing 20 to 30% appreciation or 40% appreciation in the past 18 months, and the skyrocketing rent only increased to the tune of 10 to 15%. We have a disparity between rent to value, right? So we have to you and I, Maureen, we have to tell the prospective investor, look, you need to come down. You need to come down to reality. All right, and we need to think something like 0.07% of the value of the house. So 250,000 multiplied by 0.6 to 0.7%, the gross monthly rent is like $1,600, $1,700 in this example, right? That's the reality of the market. You have to, so we have to you and I, Maureen, have to re-educate investors, whether they're newbies or experienced investors, because they come in with an unrealistic expectation. But so the cash flow in this case, we have projected rent of $1,600 on this property, right? In Pleasant Grove, Alabama, and giving 20% down payment at 5% interest rate. At the end of the day, you're getting $265 monthly positive cash flow. And you see the capitalization rate on the upper right-hand corner, 6%. That's very good. Anytime you have a capitalization rate higher than 5%, that's above the benchmark. Rent to value ratio, same thing. So 1,600 is really being realistic. So, our investors are thinking, oh, I'm only getting $265 monthly cash flow. That's not good enough. No, look at the big picture. You are only looking at the first year projection. All right. Let's look at the subsequent year projection. All right, Maureen, I want you to be patient, and I'm going to get your input momentarily. All right. So the number's okay, right? I know interest rate is 4.5. It's a little bit higher. I did this a few months ago before the interest rate rise. As you can see, $1,600 monthly rent. You see the, if you can get a property tax rate of less than 1% of the purchase price, your cash flow gets better. Insurance $56 per month. Property management fee 8 to 10% equals $125 monthly. Then I factor in some little bit of vacancy and maintenance factors, and a realistic appreciation rate. We are making assumption of 5%. We make an assumption of rental increase on an annual basis of 5% and realistic appreciation rate of 5%. Is that realistic to project, right? Maureen, agree so far? Maureen, can you say something? I cannot hear your audio.
Yes.
Okay,
Can you hear me?
okay. Yeah, okay. Sometimes your audio come in and out. Anyway, that's fine. All right, now here I need your input. Now, hopefully you can see the numbers. I have one more slide. I have 2 slides. This slide is a 10-year performance projection. I tell you, real estate investors out there, please listen to this video presentation. If you have to listen multiple times to really understand it, please do so, right? You get a copy of this. Now, this is important. You have to look at the total long-term investment, 10 years and beyond. It's not only about cash flow, right? Cash flow is just one component, right? If you have a little bit of cash flow as a starting point, that's fine. Look at the year 1, year 2, year 3, year 4. Look at this. Look at the numbers, all right? Okay, Maureen, look at the 5% rental increase. Look at the annual rent. The first year's $19,200, second year $20,600, and third year. So you're getting increasing cash flow, right? Furthermore, yes, I know taxes, insurance also increased and what have you, but you're getting more cash flow down the road. So you have to look at the whole big picture, all right? Now, And then let's talk about this income analysis. Loan analysis is the most critical. So let me finish up. Then Maureen, you take over. Okay, I'm talking too much. In fact, can you see well? Can you see what? Can you?
Yes.
Can you verbally analyze? Let me give you a quick intro before you take over momentarily. Now you look at the net operating income, which is which your monthly, annual gross rent minus the mortgage payment. By the way, you're getting a 30-year fix. 30-year fix is the amazing debt leveraging. Is the eighth wonder of the world, getting the 30-year fixed rate mortgage. Okay, so look at the cash flow at the top, systematically rising, and your mortgage payment are being paid. And then, look, investors need to look at principal reduction. The renter, your renter will make you rich. Your renter, you put 20 to 25% down payment, your renter will take care of your house for years to come. Nothing more out of pocket. I repeat, almost nothing out of pocket beyond your down payment. So okay, go ahead, Maureen. Go ahead.
Yeah. So I like where you're going. I like the messaging here because what you're really focused on is, and it's nice that you're helping investors as they're starting to look at these pro formas, as they're looking at, okay, do I want to buy my first investment property? How do I evaluate the data? I'm just looking at some numbers on a page that someone else created. Although I do have my analytical types, they have their own data sheet and spreadsheets, which I love because I can understand their risk level, their risk tolerance. Are they someone that's going to allocate 8% aside for vacancy and maintenance, or 8% for vacancy, 8% for maintenance, because their risk tolerance is really low? They want to have more set aside and go, okay, if the worst case scenario happens, do I still get cash flow, right? Every single person, this has been drilled into us for a very, very long time, is if you're buying rental real estate, rental property at all, it is all about the cash flow. You want to see the dollars in your account. What Seewing is trying to share with you is that it is real estate investing is more than just the cash flow. There are multiple ways that we earn as real estate investors. And all of them are phenomenal hedges against inflation. And the real way to create wealth and to create generational wealth for your family, for yourself and your family, is whatever vehicle you choose to put your capital in. Seewing and I happen to like single family rental properties. You may like cannabis or cacao or agriculture or commercial real estate or mobile home parks or raw land where you can rent billboards out. It's whatever your flavor is. The thing about your flavor and where you put your capital is it has to produce a yield higher than inflation. And when you take the, and Seewing was showing each year your cash flow gets more and more as you progress from 1 year to year 10 and beyond, is because you've got rent inflation or rent escalation year over year against a fixed rate 30-year note where the expense never changes, but your cash flow increases because the rent increases over time. Now, he also mentioned, and this is true, other costs rise as well, insurance and property insurance and taxes. That is true. The rent has to outpace the increased cost. Right. And as long as that continues to work, then this works from a cash flow perspective. Now, I'm going to blow your mind here for a second. It is you have zero cash flow for the year, negative cash flow even for the year. And still, because maybe your expected cash flow for the year was $2,500. You use leveraged funds, you were expecting $2,500 for the end of the year, and you had a $2,500 expense or greater. Let's call it $2,700. So you're negative for the entire year, negative cash flow. Does that mean that was a bad investment? No. It might have been a bad year on the cash flow side, but say that $100,000 property that you bought, you put 20% down, 20,000, appreciated 20,000. It's kind of the same example that I gave last time. It appreciated 20,000, right? So you've got the, and I'm going to take the example here. You've got in year one, we're going to add your principal reduction, which is 3226, which the renter paid for you, by the way. And think about it. Your rental property consists of two parts, right? You've got the principal, which is like putting money back into your account year after year. And that's someone else is doing it, called the renter. And then the expense really is just the interest, is what you're paying the banker to, for the money that they lent you. So when you take let's say you've got a worst case scenario, negative cash flow for the year, minus, you were supposed to make 2,500, you were negative 2,700, okay? But you saw let's see, 20% increase in your capital, in your equity, home equity. You saw a principal reduction, like money putting back in your account, of over $3,000 for the year. Then you have your depreciation, which you can take on your schedule every single year, which allows you to deduct the wear and tear, essentially, on the property. There is useful life that is allocated by years from the IRS, and you get to a certain point, and like for a roof, after 25 years, if it's an asphalt shingle, it's beyond its useful life, right? So you are allowed to take these annual deductions every single year on your tax schedule for 27 and a half years. Now, I do have to say that if you were to sell the property before then, there's the recapture part of that, that you would have to pay back, but you are allowed every year to take that deduction. So when you really look at this, you could have a negative cash flow year, but still be positive overall. Your overall rate of return could be even higher than you expected, even if you had a negative cash flow year. Because when you factor in capital appreciation, loan pay down, depreciation, and the hedge against inflation, then all of these things combined can produce a higher yield, even in a negative cash flow year. That's the power of real estate. It's not one way that you earn. It's multiple ways, as Seewing beautifully described here, and was showing you. And when you're making a decision on your first investment property, we all get tunnel vision, and we just look at year one and we go, and right now with the higher interest rates, they're probably not as good as they were before. But project out. This is a long-term buy and hold. This is not a hold for 2 years and sell it. This is, let's hold this property for 10 years. We're at the end of, at the 10-year mark, I've got a 22.5% cash on cash return. I've got a 14.7% return on equity. I've got annual cash flow of 24,000 plus. I'm sorry, that was wrong. Cash flow 12,134. And then my property appreciated nearly 20 grand. And the gross income for that 10 years, 36,000. So if you look at your $20,000 down payment, actually that's wrong because this is $250,000. So your $50,000 down payment in 10 years produced you 36,000 in cash plus all the other benefits.
Yeah, I mean, you can make the argument over time, 10 years or more, we heard the word 10x, you're 10x in your initial investment, your at-risk investment. And this numerical analysis, I know most investors, they use their own maybe Excel spreadsheet, maybe not good enough. I mean, I use, propertytracker.com. That's why I came up with these numbers. But if you look at the numbers, if you look at over time, right, you look at the market value at a mere 5% growth from year to year. You bought at 250, and then the first year at 5% appreciation projection. We don't know the future. You see the market value of your home grow, consistently, right? Even if there's a market correction, maybe even as a crash, which is unlikely, as a real estate investor, you stay the course. You just collect your rent, collect your cash flow. Okay, the market will come back. Always has been, always will be. Over time, 10 years or more, you will make your money one way or the other. So don't worry about, correction, crash, bubble, all this, nonsense you hear out there in a negative social media world out there, right? So stay the course, invest for the long term, get a good rental market, good tenant out there, and these days you can get a tenant for 3 or 4 years at a time because there's a lack of homes to rent. People are fighting tooth and nail to try to rent a single family home these days, right? All over the country, right? I mean, just such a low amount of inventory to buy and low amount of inventory to rent. So we are becoming a nation of renters. So that bodes well for real estate investors, Maureen. This is too good to be true, right? Oh my goodness. Okay, let me finish up. Okay, I'm getting too excited about this. We only have 2 more minutes. All right, we can talk all day, right? But but we got things to do, places to go, and people to see, right? So at the end
Very true.
Yeah, at the end of the day, your market value of your property hopefully long-term increase year by year. Then your loan balance decreases because your renter is making you rich and wealthy, right? When you have market value of your home over time increases, your loan balance decreases, then you have equity. Look at the systematic equity growth. And then when you have loan to value ratio of hovering around 60%, here's a potential cash out refi. You could even take some money out of your equity of your rental properties to buy more rental properties. That's how you leverage, right? Leverage is the key to your wealth, right? So anyway, even if you sell your property, look at the number, right? You pay your capital gains and you still have a nice profit down the road in the future, or you can do a 1031 exchange and defer your capital gains. Anyway, multiple ways to make money long-term. So that's the message, Maureen and I, as we conclude on this presentation, 1 minute left, whatever. So I'll allow you to, Maureen, to do by the way, we have, you guys have new construction. Okay, let's promote your market a little bit. As Spartan Invest, you have these kind of new construction homes coming online this year in various markets in Alabama and Tennessee. So you guys are capturing that segment of the region of the of the South. I mean, so this is kind of investment opportunities you guys have off market, strictly for investors. No need to bid out there. So very, very exciting. But you, as always, as you mentioned, your company, even my company, does not have enough supply of homes to meet the tremendous appetite of our members, of our investors, even though we only sell it to our investors. So what is your quick final recap before we conclude this presentation?
The best time to buy real estate was yesterday. The other better day is today. It's one of those equity bill. It's a game changer. I mean, if you look at the history of families that have a lot of wealth, they own a lot of real estate, a variety of real estate. We just happen to specialize in like the single family because it's an easier barrier of entry. It's usually, with a commercial building, you're looking at millions of dollars. You've got to come down with say 20% of, a $5 million building, whereas you come down with 20% for $150,000 or a $250,000 brand new house. That's $25,000 to $50,000. That's much more palatable and doable. Probably even money you've got it in your 401k. You could take it out, loan it to yourself, and use it as a down payment and start capitalizing on the home equity appreciation, the loan pay down or the principal reduction, the tax benefits that you get through depreciation in the 1031 exchange, and the cash flow that you get in this market. And here's one other thing to think about for those investors that are sitting on the sideline going, no, the rates are too high. I'm going to wait till the rates come down. Buy it now, refinance later when the rates go down, right? Then your cash flow will go up at that point. So it's just, you got to use it. You have to look at real estate as a tool to help build wealth for your family. And you just have to understand how that tool works, some of the risks that are there. And I can tell you here, I will summarize your risk in 2 things. The 2 ways you lose money in real estate is through expensive repair bills, really big, like large CapEx, replacing roofs and HVACs and water heaters, things like that, or really long weeks or months of vacancy. And if you've got a really good operator on the ground, there's ways to mitigate those risks. And guess what? If you have an expense, you just pay for it and move on. If you have a vacancy, we just fill it. Or if you've got a problem child renter, we move them out, get another one in, problem solved. That's it.
Yep.
Maybe, but it's fixable and solvable in a short period of time.
At the end of the day, work with a turnkey provider that have the umbrella of services that can provide in-house property management. So therefore, regardless of where you live, whether you live in California or Chicago or Boston or New York City or wherever, you as an out-of-state passive risk investor, you have the ability to buy 10 investment properties over time. These type of properties, you know, 100 grand to 400,000, as long as the rent covers your give you cash flow, you could buy 10 properties using a turnkey provider and invest over time. Guess how much time you need to devote to your to managing your real estate portfolio in any given week or any given month. Even if you own 10 properties, you own under your name, is single family homes or duplex or fourplex, whatever. So let me give you a hint. Okay, most of our investors and most of Maureen's investors, even if you own 10 properties in these turnkey properties, the time you as an investor can spend each month to managing this portfolio, I would say 5 hours per month out of your time to manage your massive real estate portfolio. Am I right or wrong?
It doesn't take very long, just because it's the renter or the investor's responsibility is just to check their portal, check, see if the money's there, if there were any expenses, do they match up, talk to the customer service person who updates you on the performance of your portfolio. We have a proprietary report card that will give the annualized net rate of return, cash flow. We include appreciation and depreciation in this report card to see how well our investors are meeting the goals that they set out for themselves and the ones that we said we could meet for them. And it's a good, litmus test. Are we doing what we're supposed to do to get where they need to be, or do we need to improve to get better? And we use that as a tool every 5 business days. We're having a meeting on how we can be better as a company. So you just got to have organized people on the ground that care about your outcome.
That's right. That says it all, Maureen. You're an awesome, great communicator and great consultant to investors. Thank you so much, Maureen McCann from Spartan Invest, to have a great presentation. As always, thank you so much. This is Seewing from the Year Real Estate Network. Have a nice day, and we will see you on the other side. Goodbye.